So many market headlines, and the guy to comment that is the guy who anticipated many of the things that are going on right now with the African swine fever and on what China is up to. Right here on Connected Farmer, your channel to keep you up to date with the latest trends in agriculture and livestock. Stay tuned and don't forget to subscribe. So, Mike, I would like to start by the Fed decision, and then we can talk about on what China is up to because there are many things going on in China. So the Fed decision left everything unchanged right before we record this. So what does that going to mean for the farm economy?
Yeah, and it's interesting. The headline was really no changes, but as you looked at their detailed analysis, Luis, there was a lot of market signaling done, in my opinion. In other words, a lot of information the Fed provided to the market to give more of an inflationary bias. And what I mean by that is they came in and increased 2021 US gross domestic product to 6.5% increase. And that's a pretty lofty number, but they feel because of that stimulus, this most recent stimulus package of almost $2 trillion passing, and maybe they're expecting some type of infrastructure bill to pass as well. They really bumped up the growth. So the first thing I looked at was that. And then the very second thing I looked at was not what their expectations for interest rates were, but what were their expectations for inflation the next 10 quarters, because they went 10 quarters out. They go all the way out to 2023 right now in some of their figures and estimations. And as a poll, as a group of Federal Reserve governors and presidents, they did not get much above 2% in any quarter as far as a mean inflation number for the next 2.5 years. That really surprised me, because if you're going to have that strong of growth and not have inflation, what does that spell? Well, it spells cost push inflation. It spells higher prices because of tighter supplies, because of bottlenecks in the supply chain. Plastic prices this week hit an all-time high. We know what copper's been doing because of the ESG funding for the environmental venture capital groups, and also the new green maneuvering that we're going to start to see in some of the vehicles and some of the transportation. And related to that, I think it's important to realize what happened on Thursday's trade. When we talk about the Federal Reserve, it's not a coincidence that the IEA, the world's biggest private forecaster, and a very big market moving agency, when they do forecasts, they projected that while crude oil demand over the next 5 years would increase and get back to pre-pandemic levels, motor gasoline would not ever get back to pre-pandemic levels. So between the Federal Reserve and the IEA numbers and forecasts, you saw on Thursday a sharp 7% correction in the crude oil. That naturally brought the dollar up. Or you could look at it the opposite way. The Federal Reserve increased the dollar and made it go up, and the crude oil was forced to go down as a result. Either way you cut it, the 2-year bond yields are at 13-month highs now. The 5-year bond yields are at 15-month highs now. And that has triggered more bond buying, which it takes US dollars to buy. So the dollar strength is there. I mean, we see that in the fundamentals. We see that in the forecasts now. And the big question is, does it continue on, and do we break above 92.65 in the dollar index? If we do, that would be a trend shift to a stronger dollar and a deflationary dollar. So goodbye to the inflation bull for now would be how I would look at it.
But do you still think that would be a great year for agricultural investment?
Well, I think it doesn't make it as easy. I think, what you and I talked about is there's two big groups of bulls out there in the ag. It's the La Nina weather bull and the reflation inflation bull. And that really helps support the market and underpins the market until we know about the United States weather pattern this summer or this spring for the planting, which is right upon us. I mean, we've got to realize that Texas is now over 25% planted. And I think it was Mississippi that got into the teens this past week as far as planting. So I guess what I'm getting at is the fundamentals of the corn remain very solid, minus the wheat. But if you're looking for a bullish scenario because of the La Nina, you can't ask for that as much as you used to because of what's happened in the corn belt and the wheat belt. I mean, look at what wheat prices have done. I think we're down 9% off of our highs now in the wheat, and that high was just made about a month ago. So the wheat has not given us any leadership. The weather, therefore, is the La Nina bull is wavering, I think. And then you drift over to the reflationary bull. I think he's wavering after what you and I just discussed.
Yes, and I would like to jump into this week's headlines right now. This part of the program, I would like to mention our viewer Tim Default from Minnesota. He's a grower, and he always likes to see questions about China. So this week we had several purchases of corn from the United States, and that has not reflected on prices. Why
No.
is that?
Well, number one would be the wheat market. I think that's the number one issue is the funds are not going to buy corn with the wheat so discount to the corn right now. And with the length that they still hold in the market, we had a chance to see the funds buy more corn when we extended position limits on Monday. Nothing happened. And so that was kind of a red flag to me. The spread stayed firm on the demand from China. In other words, the May and the July stayed stronger against the December. And that was good to see. And the cash market has remained firm here in the United States. That's good to see. But as far as the futures goes, I think we're really at a point again, like we were about 7, 8 months ago, where like the beans, who wanted to go higher but couldn't because of the wheat or the corn. I think the corn wants to go higher, but it can't without the beans or the wheat. And I say that especially going into the acreage and grain stocks report, because from almost all indications I have from the colleagues I work with, Luis, is that in the Newswire estimates that I've looked at, is the trade's much more nervous about tighter supplies of soybeans on the stocks report and a lower acreage base of soybeans on the acreage report. In fact, the average trade guess for corn acres on the Reuters report, I think, was almost 93 million acres. So almost a million more than what USDA gave us last month, which I thought that was a very high number. So I think those are the biggest reasons why corn hasn't been able to go up. I think the other thing that goes back to is the African swine fever issue and the fact that, and this ties into the meal market, which ties into the corn market. The African swine fever issue in China has kept the real lid on the meal and has not allowed it to go higher. And I think the last reason that the corn market is maybe waiting for the next big report to come out at the end of the month, two reports to come out at the end of the month, is the idea that because we're now 75% roughly planted in the second crop safrinha corn, and we're approaching that 50% harvest mark in the Brazilian soybean harvest, South America is less of a news story and less of a driver in price. And we're going to have to find out from the next official update in April to see whether our estimate of sub 130 on soybean production for Brazil is more closely aligned with what's actually happening in Brazil versus these big lofty numbers of 133 to 135 million metric tons.
Yes, we have anticipated what would happen in South America. And you have warned several people on this program about the further reductions that would happen both in Brazil and Argentina. And it seems that could be 10 million metric tons less in the market than previously expected. That being of less than 130 million metric tons in Brazil, and the Argentine soybean crop under 45 million metric tons when the first expectation was 50. So where does these soybeans will come from in the coming months?
Yeah, you just described for me how I would lay out the next 15 days, the rest of the month of March before the acreage and stocks report, what would drive the trade. And that is the La Nina bull running away, the reflation bull potentially running away, versus what should drive the trade 30 days from now once we get the April WASDE report. And that is a tighter, lower supply in South America, which makes China continue to have to buy both beans and corn from us in the United States to a greater percentage than they would want to. And that in and of itself can help offset the weather La Nina issue and the reflation issue. But we just have to wait for it. And I think it's a waiting game. It's a game of patience. And that's why I do the sell and defend model this year, is because I don't know that I'm right about a lower bean production in Brazil. I've been, as you say, we've been shown to be correct on Argentina, especially when it comes to corn and beans. And I think we're going to be right on corn as well in Brazil. But that's why I do the sell and defend model and get both sides covered until I know more. And I think this is a perfect week to look at that African swine fever issue. You and I have talked about how I've been more nervous about it, and that it's a bigger issue than what the trade was thinking maybe 2 or 3 weeks ago. Well, now the trade's caught up with that. And I think a big piece of the puzzle came Thursday when it was reported from sources that China sent around a document, the government sent around a document telling its large hog breeders to find a way to cut their rations of corn and meal. The interesting point about this, Luis, is why would they need to do that if there was a big problem in the hog herd? And I think the answer to that is that they have a tighter supply of hogs right now, but they themselves just reported their breeding or sow inventory numbers for the month of February were almost 35% higher versus a year ago in February. And so they are coming on with bigger supplies, bigger hogs. Their numbers are increasing. So I don't think it makes sense that they'll be able to ration much corn and meal out of their rations unless they find a substitute like wheat or rice. But that only goes so far, especially since they've been decided to take the path of the Western hog producer and get into the more of the manufacturing of the very large feeders that use compound feed. So you can't ration out too much of the corn and meal, or your hogs won't do as well. So this is a new dynamic that I think is actually supportive of the corn and soy meal demand. Again, once we get past the next 30 days or so.
Before I get a deeper opinion on hogs, I would like to get into corn because not only the South American crop is getting worse, and I'm getting information about reducing yields in most of the regions, not only in the south, not only in the two southern states, but also in Mato Grosso. And now I am having news of bad weather in the northeast of Brazil. So basically, you are having more problems with the weather at many stages of the crop, and that's really hard to get record yields.
Now, my question to you would be, and this is something you and I have talked about before, the price is always right. That's kind of the model of commodities, especially the Gulf of Mexico price against the Port of Paranagua price or the upriver Argentinian price. We've seen these prices go down, though, recently. When do you think, or historically, Luis, do you have any idea of when that South American port price and export price would start to go higher and actually give the signal that these lower supply issues are real and that there are indeed these crop problems out there?
Yeah, that would depend a lot on the weather because the transportation in Mato Grosso is delayed because of excessive rain. The grains cannot get to the Brazilian ports right now because of excessive rains in Mato Grosso. And related to that, I'm hearing that several packing facilities and several pork producers in Brazil, they cannot afford the current corn prices. So, and that goes back to something that we speak about every year, about the possibility of Brazil importing more grain from the United States. But that is also really hard because the US grain is based on US dollars. And if the domestic grain is expensive, it's really tough to get cheaper corn or soybeans from outside of the country.
Yeah, and I want to say that if I remember right, I thought that Brazil was on the list for the weekly export sales, but I'm not seeing that yet, and I can't remember which commodity it was. But I think related to your point, wasn't there? I think there was a BRF packing facility that had to lay off 150 people because they just are going to shut down because of the high price of the grains, or they're going to have to cut costs if they keep manufacturing and processing. I believe it was a pork plant, if I remember right.
Yes, that's right. That's exactly right. So, in that context, I would like to get your opinion about the hog market in the US.
Well, I think we've had there was disease problems here in this country, and obviously the Chinese need more pork, and we saw that again on the weekly export sales. However, I think the weekly export sales also showed some rationing in the Chinese demand because Mexico was by far the number one buyer this week. China was number two, but it was a distant buyer of the number two. It was the distant number two buyer, and that was because there were actually some net reductions. And I think there was 1,300 metric tons of pork that they reduced. So they essentially scaled back their purchases from us. And so I think maybe the price is getting to them as well on what they actually want to be able to buy at these higher price levels. So between that and the bellies running to prices that are kind of counter seasonally high, not kind of, they're very counter seasonally high. We have what's called a BLT seasonal, bacon, lettuce, tomato sandwich seasonal in the summertime here. And it really is more in the middle part of the summer when the tomatoes come on. So more like July, August is when we get the bacon seasonal for the summertime, and people buy a lot of bacon to cut their tomatoes with and eat it on a sandwich. And that's a very strong seasonal, but I think we're way early on that. And so I think the bellies have a real big premium in them. I think the Chinese are peaking in terms of their consumption right now and what they're willing to buy at these price levels. And I think in my experience of doing hog analysis, Luis, it's oftentimes the case in these kind of rallies in late winter, early spring, that the April contract tends to be kind of the rocket fuel to propel you higher. And as that April contract goes off the board and expires, you're kind of left with very little to propel the prices higher. And I think that's kind of what's happening. We may have started to see that already on Thursday with a real sharp pullback after these export sales were reported, given the Chinese not buying as much. But then as April goes off the board and May takes over as lead month futures, May's typically a weak month. So I would say I'm a hedger. I'm a hedger here in the summer months, especially getting up to that 101, 102 level that we saw in the June and July futures.
Are there any producers, a significant number of producers that are shifting the meals from one source to another source?
No, not at this time. I think what you're seeing right now is that the pork producer has had a really good time at the retail meat counter and at the restaurants because beef is still in the supply chain kind of out of place. You can't get certain cuts in the grocery store. You can't get certain cuts in the restaurant. And the prices for the pork were much more competitive with the chicken and the poultry prices. And so pork had a sweet spot in this last 3 months. So the retail side was strong. There was disease pressure on the beginning of the supply chain, and beef was, trying to figure out where it was at in terms of taste and preference with the consumer. And then you had this outside market hit of the export demand by the Chinese. And so I do think this is getting it's running very long at this point as far as the rally. And I feel fairly certain that we're starting to ration demand. I do to your question, I do hear more and more producers buying $80 and $90 sows, so and retaining gilts. So I think these prices have been high enough, long enough. We're repopulating the female herd, and the breeding inventories are going to start to go up as we get into the later part of the summer.
We spoke a lot about the wheat crop in the U.S. in the last couple of weeks, and there were some reports about the improving weather in Kansas and Oklahoma. What do you see about the crop right now, and your expectation about prices?
Yeah, what we talked about 2 weeks ago, I think, has been right on. We have had a crop saving rain, and the drought monitor started to show that on Thursday of this week as well for the Plain States. But the idea from USDA that Kansas came in with a topsoil moisture that improved 23%, I think that's 100% correct. Oklahoma, I think they're the number 2 hard red wheat state, if I remember right, either Colorado or Oklahoma. They came in at 57%. From good to with good to excellent, that was up 4% versus the prior week. I think those are all valid numbers. I think we've saved a crop at this point. Is it above average? No, I don't think it's above average yet, but we'll see what the rest of the spring brings us now that we've broken dormancy.
Yeah, and I would like to get into some other crops. I wanted to ask you if do you think it's time to diversify? Because I'm seeing more demand for some crops like barley, like sorghum, and China is buying more some of these other crops. Do you think it's time to diversify?
I would not at this point. I think that we have to realize, I think when it comes to China, Luis, that China's demand in the history, and when they have come in with these big demand boosts in these crops, it's usually lasts about 8 months to a year, and so I feel like that they're getting to a point where they're probably hitting price levels they're not going to be buying as much. And we do have to remember that they are coming on board with their new crop. We're coming on board with our new crop. I think the rule of thumb I've always had when it comes to shifting your rotation or getting out of something that you're used to doing is to look at it from a standpoint of the next 2 to 3 years. Is it something that is worth doing 2 to 3 years in a row? And if it is, then it's probably a good investment, because it's going to be a challenge to change your farm operation. So you need to think more in a 2 or 3 year dynamic. And, that's where it goes to non-GMO. I think that's going to be very strong. We've got a little bit of an early indication that the green energy mindset in Washington is going to be pro biodiesel. And so that could mean soybean oil fights the same demand for biodiesel. In other words, the food makers for bean oil need to fight it out and hash it out with biodiesel. So I think maybe beans, especially with the new varieties of beans that we have, maybe are a better type of positioning to be put into than the corn, especially if you're near an ethanol plant over the next 2 to 3 years is what I'm talking about. Because I do think that the IEA report that I mentioned earlier, it's clear that the electric vehicles are going to be coming on hard by 2030 and 2035. So that's kind of the thing that I want to talk about with my producers right now, about how to work around having a lot of your corn sales being made at an ethanol plant. What can you do to mitigate that before it's too late, so to speak?
This shifting mentality takes a long time, right?
It does. And especially with as high of cost and as capital intensive as we are in agriculture, both your area of Brazil, Argentina, and our area of the United States, it's very expensive.
Thanks a lot, Mike Zuzolo. Again, very good content.
Thanks, Luis. Great questions as usual, sir.